right, welcome, Armin. My name's Carl Grun. This is another installment of Coffee with Carl. Go ahead and welcome today, Alliance Bernstein. Armin, why don't you take it away and give a quick intro of yourself and the team?
Sure. Good afternoon, everybody. Thanks for joining. My name's Armand Amrit. I am a regional manager with Alliance Bernstein. I appreciate everybody's time. Thanks for having us. Today, we're joined by Walt Czaicki. He's a senior investment strategist working directly with our investment teams across cap structure and across both growth, value, domestic and international. Walt is also part of our capital markets committee, working with senior thought leaders around the firm to develop Alliance Bernstein's market point of view. He works on our capital markets outlook, and I couldn't think of anybody better to join us today and have a deep conversation around our thoughts on equity markets, obviously talking through some of the risks that we see present, but also where there's opportunity. So excited to be here. Thanks for having us. I'll kick it over to Walt to get us started.
Thank you so much, Armin. And Carl, thank you for having us as well. So it's okay, Carl, I'll try to pull up the slides at this point.
Yeah, please do.
Okay, so let me see if I could find them. It's quarter end, so it's a busy time of year, as you might expect. So can you see those? Okay.
Yeah, I mean, they're a little bit pulled out, but we can see them.
Okay. I'm going to try to take it to full screen mode and see if that shows itself a little better. Okay. So good day, good afternoon, and appreciate, as I said, everyone's time today. As Armand said, I work with our capital markets committee, and every quarter we put together, and let's just consider our view of the world. And today we'll just focus our conversation on the capital markets from a macro perspective, as well as through an equity lens. And I'll just go through just a quick recap in terms of what we saw in terms of returns. So if you look on the left-hand side, we showed the different categories, be it equities, credit, government bonds, and even alternatives. And as you look at this from left to right, the first column that you see is for the third quarter. And unlike the year-to-date returns, we saw a bit of a reversal. And if I were to go back to give you all a perspective in terms of how we see things evolving, that's always the point of an outlook, of course, is as we came into this year, there were still a number of known unknowns that we were dealing with. Namely, will the debt ceiling be lifted? Yes, it was. The regional banking crisis that we saw earlier this year seems to be contained. Inflation we saw come in significantly. That is a good thing. But as we turn the page into the second half, and let's call it early 2024, we feel we're in this period of resistance. And that could mean anything from the year-to-date returns, especially if you look in the second column, you could see that despite the third quarter, year-to-date returns in equity markets were still very solid. Credit markets a little bit the same. But some of that's resistance that we said is a benefactor of the year-to-date performance being so strong is that equity multiples in the stock market had risen dramatically, and that was most of the stock market's return. It wasn't so much from earnings, it was from multiples going higher. So you had elevated valuations, you had rates, and we're in this rate environment where we believe we're going to be higher for longer, and inflation remains stubborn. Although we've seen some improvement, we think we might see a bit of an uptick in the year end, and that's going to be mostly in the services area, which I'll put a little more definition around. But nonetheless, despite the year-to-date returns, we hit this pocket of resistance, as I said, in the third quarter. Ultimately, as we get into late 2024 and 2025, we think we get to a period of what we're going to call normalization. We don't believe we're there yet, but normalization is just effectively a lot of the areas that got impacted by the COVID pandemic, be it the economic growth, the labor markets, inflation. We think that tends to go back to long-term trend. And if that's the case, we think that's just a much better backdrop than this resistance period for both the equity and the fixed income markets. So I wanted to give you a sense in terms of the chapters of what we see and see how this evolves. But I think the tail of the tape has affirmed what we've been calling for. One of the things I mentioned quickly was inflation, and it's still high. I'm not going to sugarcoat it, but we've seen some degree of improvement. In other words, we're not seeing it raise, we're not seeing it continue to raise. And that's what some of these bar charts are showing. Food prices, again, they're high, but the good news is we're starting to see them moderate. We're not seeing them climb at the levels that we saw last year in 2022. And the one way I could put a bit of an example of that is Walmart, in fact, has been pushing back on a number of their vendors, be it General Mills and other companies of that ilk, saying time out on price increases. Consumers are not buying as much. There's a bit of a buyer strike. They're trading down to private label. You guys are not going to be able to raise prices to the same extent that you had. Energy prices are a bit of a wild card. That's why the Fed tends to take them out of some of their inflation measures, or really to dictate monetary policy, because they are so volatile. Unfortunately, it's back into the scene with what is going on in the Middle East. But we saw some degree of relief, say, for what we saw in the Middle East. So we need to keep our eye out on that. Goods prices, think of this as anything that you buy off of Amazon. It's the things that we buy, or if it's even bigger ticket items, say furniture or home appliances. We've seen in most cases, goods prices that you could see here have come down pretty substantially in the lower left. The area that's been the sticky part, and it's a big part of the U.S. economy, are services prices. So that could be a nebulous term, but let me try to put some more definition around that. That could be anything from car insurance, health insurance premiums. That could be anything from cable services in terms of what you pay for your cable bill to concert tickets. And people are spending their money differently. They were pretty flush with cash coming into the pandemic. We saw a lot of stimulus money come in. Granted, some people need it, other people maybe not to the same degree, but people are still spending. And while they're not buying exercise equipment or home furniture, as an example, they're spending differently on experiences and travel. So this is where the Fed needs to keep an eye on, where, as I said, we've seen a degree of relief in some areas, but this is still a point of contention that the markets are wrestling with.
Do you think that services are really going to change, though? I mean, haven't we had just a fundamental shift towards experiences in general? So, I mean, some of these numbers seem like they're just going to stay that way well into the future.
Yeah, no, it's one would certainly think so, and we are a services economy, Carl, to be sure. So that's going to be an area where it's going to be firm, and the consumer, in many cases, the U.S. consumer has been, as I like to say, written off more times than Enron's debt. But there are periods of time, which is a perfect segue to this slide, which they pull back on their purchases, and that's where we start to see some cracks in the veneer. We're not saying, oh, they're not going to ever spend again, but they may spend less at some point. We think that this tuckers out. So the perfect segue to some of these charts here, which we have to keep an eye on the consumer. It's roughly 70% of the U.S. economy. So the good news is take-home pay, effectively, in plain English, that's what this chart on the left is showing. This is just what people are taking take home in their pay. Now, granted, we've seen take-home pay come down from the peak levels, but it's still in positive territory. So that's not a bad thing. The good thing also for the consumer, the second chart, is their debt payments versus their take-home pay or disposable personal income are not super, super high. So you want to see this line go lower. This is just things like mortgage, or credit card payments, auto payments, etc. Granted, they've come off of their lows because interest rates have come up a bit higher here. But nonetheless, consumers are still managing their balance sheet okay. We're not at levels if we say go back to the mid 2000s, where debt payments versus what their take-home pay was a big chunk of the money. But and this is to your question, Carl, some of the excess savings that we had are starting to moderate. It's starting to tucker out. Now, granted, this is just showing household liquid assets. This is money in savings accounts, checking accounts, money market funds, increasingly this day. It's getting closer to that long-term trend. We're not saying, oh my gosh, the sky is falling, but to your question, at some point, we think this starts to tucker out. Especially when people have less cash excess cash and they spend down their savings. And what we're starting to see too is that there's fewer job openings that are out there. A lot of this is just a byproduct of a lot of the tightening we've seen in the system. I talked about energy prices. If oil prices go higher, especially in lower wage cohorts, that's less money people have in their pocket to spend. We've had the Federal Reserve tighten. They're likely to take a pause. Great timing for the call. We think they take a pause now, but it's going to be a jump ball whether they hike again in December. There's a good chance that they might have to if this strength persists. So you've got that tightening, mortgage rates, credit card rates, you name it. There's a lot of tightening in the system. So I think that ultimately leads to a slowdown in some of that services component, Carl.
Hey, well, can you display the slides just on a full screen?
Yeah.
Presenter view, make it a little bit easier.
Yeah, I tried to do that. It's showing full screen on mine. I'm sorry, I'm not showing. It's not doing that. Armand, is that something maybe you could do from your end if I hit the stop share? Do you have the deck with you right now?
Yeah, I'll go ahead and work on that. You can just keep on going, then I'll see what I can do.
Armand, let me know when you want me to hit stop share.
Sure. Give me one second.
So we'll go to and interrupt me anytime, Armand. So where does this all take us from an economic? Where do we see the ball going, if you will? This is just a chart that shows our forecast for economic growth, inflation, what we think the Fed is going to do, et cetera. And we show different regions here on the left. In the U.S., we highlighted in blue. That's the middle bar that you see here. So for this year, yes, economic growth has come in higher than expected. This is a year-over-year average. Currently, we think it's at 2%. I would think it settles a little higher than that in terms of this is real economic or real GDP growth. Next year, though, we do see it slowing. We're not in the recession camp, but you could see we just show like 0.5% economic growth. It's still positive, but it's not great. And a lot of it just has to do with, as I mentioned before, all the tightening we have in the system. At some point, we think that has an effect on slowing down consumer spending and just slowing down loan growth, which we're seeing, et cetera. If that happens, the economy tends to slow. And then inflation, again, this is just a year-over-year percent change. We see it coming in, and this is about where it's trending at about 4%. Next year, we've seen that getting a little closer to the long-term average at about 2.5%. This is where we say official rates. This is effectively the Fed funds rate. This is where we think the Fed is going to dial interest rates. This year, we're at 5 3/8, if you will, on the Fed funds rate. Again, there's a chance in December that they maybe take it up another 25 basis points. Our base case is that is not going to happen, but that's where we see things at this point right now.
So I see you have before getting to 3%. So where do you see the big drop off? I mean, how do we get there? And I guess the question too, next one follow up of that be, do you see the Fed eventually capitulating on this 2% number that they've kind of created? I think more or less out of thin air over the years, but do we just say, hey, really, given that we've brought a lot more manufacturing and other things onshore, does that change the long-term projection? And can we, even get back to 2? And how do you guys think about that as far as the overall market performance too?
Yeah. So with the Fed there is a high degree of debate whether they settle at a higher rate, Carl, right? Whether they say, well, we're going to be higher than the pandemic for some of the factors that you mentioned in terms of reshoring, onshoring initiatives, which is good for the job growth, but that tends to be inflationary versus the experience that we've had for quite a while where we've offshored a lot of this. Our take is that they are committed to getting to this goal at this point, closer to this 2.5, let's call it. When they say that 2%, this Fed is talking about not an absolute level, it's more of an average. So we think that we could get right around that 3% or somewhat below. A lot of it just goes to the fact that a lot of this tightening that, again, I go back to everything that we have, the tightening in the system with the consumer slowing down. If that's the case, then we do think that inflation will moderate to these levels. Whether it's going to be, if the Fed does say, look, we're going to just have to deal with 3%, I don't think that that's the death knell for the capital markets. I think that's the second part of your question. Because if they set expectations accordingly, if that is true, that we don't get this low, if they could manage expectations around that, then I think the markets will adjust, but not necessarily in a negative way. The key is if we're going to get a continued level of improvement in that inflation rate to where it's not run away. And the good news is that consumers aren't expecting that to happen. Where you get the kind of the inflation expectations effect is when all of us on this call say, I'm going to buy stuff now because it's going to go up in price. Then it becomes a self-fulfilling prophecy, and then the Fed's got a massive problem. Fortunately, that's not the case at this point.
Are you guys expecting AI to have any driver on long-term inflation? I imagine that's not really something realistic today, but down the line, and and how you guys project that into the equation.
Yeah. So hang on, Armand. I think you were trying to share your screen there. So thank you. So your question is in terms of on the AI side.
Yeah.
Yeah. Longer term, Carl, I think it could enhance productivity, which it would be a reduction in inflation, but we're still in early stages on that. And it is encouraging. It could be something that could be a boon to enhance that productivity. And if that does manifest, that could maybe even take the inflation rate lower than what we're looking for. But we just think it's too early to declare that is being an absolute at this stage in the game.
Okay.
Would we want to go to the next slide, or Carl, did you have any other thoughts or questions you'd like to?
Next one. Yeah, go ahead.
Okay. This is something that the markets have been dealing with for all this year. And it's been pretty extraordinary in that the thing that has been leading, in this case, the S&P and some of the other large cap indices a lot higher, has been the largest mega cap stocks. A lot of these are familiar names. If it's Apple, if it's Microsoft, we list the names down there below. But the reality is, if you look on the left-hand side, it's accounted for about 86% of the market's returns. And now, again, granted, this is data through September. And again, it's not to say that these companies are terrible and it's like, oh, this is a horrible thing for the market. These are quality companies. They didn't get here by accident. But what it's led to is that there's been a real bifurcation in the markets. If you look at the middle display, what we're showing is the price to earnings ratio of the 10 biggest stocks in the S&P, which is that top line, versus the rest of the market's PE. There's 490 other stocks in this index. You can see that there's a substantial difference in terms of where the rest of the market is trading versus where you see the top 10 biggest stocks. So casually, one would say, well, the equity market's expensive because your forward PE is at 17 times earnings on the S&P. But when you look below the surface, there's a real skew of those top 10 names. In fact, if you look at the right-hand side there, the premium of the top 10 biggest stocks, their price to earnings ratio versus the other 490, it's come down, but it's still at 60%. That is a massive premium. And again, we own some of these names in some of our portfolios. Again, they're good businesses, high quality. But as an active manager, this could give you a headache because that's really dominated the performance. And some of these companies have become big. Apple Computer got to close to a $3 trillion market cap at its peak. That's bigger than the entire small cap index, the Russell 2000. We think that that's a bit overdone. And there's within those 490 stocks, the market is acting as if only these 10 biggest are the ones that are going to give you good earnings growth. We disagree. We think that there's other stocks that are out there that we could take advantage of. So, Carl, I don't know if you had any thoughts on this, but I could continue to say, here's the backdrop, but we're still finding some opportunities within the markets that are out there.
Well, I guess my question would be along the lines of if these are have so much, momentum or pressure on where the actual S&P goes. Is there if these names aren't going to go up as much as, can we say that, from an index standpoint, it'd be pretty hard to drive that much higher in returns?
I think, go ahead.
Yeah, I mean, I just would be, outside of trying to, go into the index and pick them, but I imagine that might make it a little harder to have a big rally from here. Or how are you guys thinking about that? More not necessarily in the short term, but over the next, 1 to 2 years.
Yeah, over the next couple of years, if we do see this goes to our third chapter in our outlook, which is the normalization phase. Again, if we're right that inflation moderates closer to the Fed's target, then once we get through the worst of the economic slowdown, then we set ourselves up for recovery. If that's the case, and you see valuations adjust in this period of resistance, as we expect them, and we're starting to see them do, we think that sets us up for a very good recovery in risk assets, not just including areas like credit and the fixed income market, but certainly on the equity side. And we just think that there's been a number of these stocks that have been overlooked and overshadowed by these Big 10. And ultimately, capital goes, I always draw the analogy. Money is like electricity. Electricity takes the path of least resistance. Money is going to go to those areas where there's the greatest opportunity. And in this case, a lot of these stocks that have been left behind in some of the areas that we'll discuss, we think they're going to be beneficiaries of that as we look out over the next, call it 18 months plus.
Okay.
So
I imagine you'll hit on that, later in the slides, right?
Yeah,
okay, perfect.
Definitely. Something else, if we can go to the next slide, Armand, is if we look at another area where we've started to see some, as I like to call it, cracks in the veneer, are some of these lower quality stocks. Now, the way that we mention this, if you look on the left-hand side, those blue bars that you see are measuring the first 6 months returns of the stocks that we consider lower quality, and I'll list them off. The high yield debt sensitive stocks, these are companies that have issued bonds that have a triple C or lower credit rating. All right, not the highest credit worthy companies. The second is the most shorted. Those are the most shorted stocks in the Russell 3000 index. That's companies like Beyond Meat, AMC Entertainment, some of these meme stocks that did so well that are like, how are these things doing so well? And then non-profitable technology companies. As the name implies, these are innovative technology-oriented companies who have no earnings. So you notice in the first 6 months, those stocks did really, really well. Versus the S&P, which is that last blue bar for the first 6 months of this year. What we were saying is this can't last. Again, I go back to all the restrictions and all the tightening we see in the economy, and ultimately those higher beta stocks versus companies that are not as volatile, those tend to not do so well when people become concerned about economic growth. And then the gold bars on that same left-hand chart are showing how those same baskets or groups of stocks, companies with not the best debt profile, companies that are heavily shorted that investors really don't think are strong fundamentally, and non-profitable tech stocks, you could see that they all underperformed meaningfully in the third quarter. And that, in fact, has continued through October. These are areas of the market that people are starting to say, no, we're not buying it. If the Fed's going to be higher for longer, and let's say they do take rates 25 basis points higher in December, if that happens, it's just going to put more pressure on these companies. If you have to refinance your debt and you're a triple C rated credit, that's going to hurt. That's going to be very expensive. So what we're saying is stay out of stocks like this, but we were calling them out by saying this just can't last. And we think that areas like this are going to remain under pressure, where, as we'll get into in the next few slides, Carl, we're talking about you want to be in a better neighborhood. It just doesn't make sense to be shopping here. And this is something where people were hoping, okay, the Fed was going to cut rates when they came into this year, and these stocks that got hit so hard in 2022, these three groups that I talked about, everybody wanted to rush back into them. We think that was a valuation mirage, and it's starting to prove out. So Armand, maybe we could go to the next slide. So when I talk about staying in a better neighborhood, what we're saying is you want to be companies, not what we just talked about, lower quality. You want to be in higher quality stocks. And specifically, quality could be a very broad and nebulous term. We put some definition around it. What we're talking about are companies who have high profitability. And we measure it in a few ways on the left when those lines that you see. Companies with a high return on asset, companies with high return on equity, companies who have strong profit margins, and companies who have a lower beta or tend to be lower volatile from a fundamental standpoint. And what we're showing is all categories of the top tier stocks in every one of the high return on asset, return on equity, lower beta, high profit margin stocks held up really well versus the S&P, down 3% last quarter. They all outperformed. Again, people are gravitating to these stocks. And yes, quality has done well this year, but there's still room to run. What we're showing on the right are just where they're priced versus their historical valuation. And again, if you look on the right-hand side, that's just their percentile ranks. You can look if it's return on equity or return on assets, they're trading at about median valuations versus their history, where the lower beta and the price of free cash flow are on the very, very cheap side. So there's still room to run, as well as these stocks have done. And I like to say that an absence of a recession is not the presence of a recovery. We do expect a recovery at some point. That's the way economic cycles work, as you know, but we think we're a ways from that. And that's why we're staying in this neighborhood. Stocks that have these characteristics, because people use that word quality all the time. We pin it down to areas such as this.
Any particular group, whether it be healthcare or energy, whatever, that you see more companies falling into this profile?
Yeah, there's quite a few. You mentioned healthcare, which I think we can go to the next slide. Armand, is that this is one of the areas that has been left behind. And what we're showing on what I show that is in a lot of the industries on the left, be it healthcare services, this is companies like a United Healthcare, some of the companies like life sciences tools and equipment, this could be medical device companies, just to name a few. The blue bars are just showing how those stocks have done. The other bars on the positive side of the ledger are showing what their expected earnings growth is over the next year. So we think that there's a real disconnect between price and fundamentals. And one of the areas that we highlight is heart valve replacements, the middle display, which is just showing one specialized area of heart valve replacements is expected to double over this decade, their addressable market from $5 to $10 billion. And you think about elective procedures, a lot of those were put off on during the pandemic because people didn't feel safe going into hospitals.
Yep.
If you have a heart catheter device that needs to be put in, you can't keep putting that off. It's not like a knee replacement. As painful as that is, you have to get this done. We're talking life or death here. And these particular heart valve replacements that we highlight, which are transcatheter aortic valve replacements, that's a mouthful, but these are less invasive. They improve mortality rates by a factor of 8 times versus open heart surgery, and it lowers the cost of healthcare. And that's always an issue in DC every year that healthcare companies are under the lens. Well, you can't charge X for this or that, but if you have innovation and you actually lower the cost of healthcare, those are areas we want to be in. So that's one such area. And again, from a valuation perspective, we show something similar in terms of the valuation percentiles for these industry groups on the far right. We just think that this is an overlooked area that is just ripe for stock price appreciation, given the high quality nature of these businesses. Another area is lower volatility stocks. Now, what we mean by that are these are companies that tended to have a high quality is some of the factors that we talked about. Very stable businesses, so they have a lower beta or lower volatile stock price, but they're attractively valued. In some of the areas that we really think are ripe for that are some of the we show on the right-hand side. We talk about some of the more popular areas like technology, some of the names that we all know, consumer discretionary, that could be names like Amazon or Tesla as an example that, again, for the most part of this year have done really well. If we look at the area on the right, those are areas that we've been taking profits in. And what those numbers are showing, again, are just valuation percentiles, where the higher the number, the more expensive the stock is. So technology, really, where we saw in August of 2023, those are areas that are still like in the 80th percentile in their valuation, versus areas that we think are more defensive and are cheaper. Healthcare being one that you see in the 39th percentile. Our consumer staples, these are food and beverage stocks, trading at the 25th percentile. So those are companies that tend to, again, have a lower degree of volatility. We still like some of the areas in technology, but we want to go into areas that are going to be a lot less crowded. So that's another area of opportunity. And I think the last area that I'd want to highlight, which is on the last slide, are dividend-oriented equities. And actually, it's the second to last one. But look, there's a lot of money in money market funds. Cash is an asset class again. We understand that. But there's going to be a point in time when the Fed is going to lower interest rates. And what we're showing on the left-hand side is just the blue bars are showing you free cash flow yield for the S&P 500 stocks. And cash is just a representative in terms of where the consensus forecasts are for Fed funds rates. Ultimately, if you look over time, within the next year or two, you start to see that the blue bars equal or exceed what you could get in a money market fund from a yield perspective. That free cash flow yield is expected to grow 7% a year. And part of what you could do if you're a company who has free cash flow is increase your dividend. So yes, you're getting paid in cash right now, but if the Fed does ultimately lower interest rates, as we expect them to do, those money market rates are going to come down, all the while you're going to be getting a rising stream of income on those dividends if you choose the right stocks. And as we talked about with some of the quality factors, if you look in the middle display, you could see that the high dividend yield factor came to the fore in terms of being defensive, which is you could see that outperformed the S&P in the quarter. And we think that while we're still going to be in this area of resistance, this is another area of opportunity that we think has been overlooked this year. And we're advising where appropriate, investors give the look. And then the last one I'll round up with it is value equities. Value stocks did very, very well last year versus growth. And what we said is you want to kind of lean into some of that growth underperformance. And we've seen growth outperform value to a substantial level. As I said before, with quality growth companies, we still think that there's gas in the tank. But if we go to that last slide, Armand, on the value equities, what we're advising is some selective rebalancing. We're not saying you back up the truck and overweight value versus growth, but the fact is if you're underweight value because growth has outperformed so substantially this year, you might want to look at certain areas of opportunity. If we go back to the index, Carl, that we were talking about, what we're showing on the left-hand side is if you look at the S&P, it's become a more growthy index, for lack of a better term. And that's what we're showing on the left, that blue line. So if you look at growth in defensive areas of the market, so growth, we talked about a couple, tech, consumer discretionary is an example, or a couple sectors there. Some of the defensive areas, be it healthcare being one, that's become a bigger and bigger part of the S&P 500 index. An area, the second line that's labeled cyclicals, this is things like industrials, financials, energy, and materials and processing companies. Those sectors have become a much smaller weight of the index. Mm-hmm. So what we think over time, especially as we expect a recovery in this cycle, not anytime near term, but if we look at the valuation opportunity, which is the middle chart, value versus growth, you're at a very compelling entry point here. And I'm not saying it's going to happen right away, but if you're looking for an area of opportunity, this is another area, again, we would say selective rebalance. And some of the more favored industries that we're showing, be it cable and satellite companies, some of the pharma companies, and even some of the building products companies, that's what we're highlighting on the right. So if I'm going to sum it up, as I said, from a macro standpoint, we certainly see things slowing down, including the consumer, Carl, but we're not in the recession camp. Quality stocks, we still think that they have room to run. That's the neighborhood you want to stay in. And areas of opportunity are areas of quality growth, be it healthcare, some of the lower volatility stocks that I mentioned, some of the more defensive areas that I highlighted. dividend yield stocks, as well as selectively rebalancing in value. So I'll turn it back to you, Carl. Any thoughts or questions from your perspective or that you might add?
Yeah, a couple of them. And then, folks, if you guys want to send in any questions to Q&A, we can go ahead and forward those in. You highlighted the conversation around cash. I get this quite often where, right now folks can lock in a CD at 5% over the next year. What would be your argument as to, where they could invest otherwise, whether it be fixed income, maybe walk through the opportunities there, or just, from the equity perspective? How would you kind of lay out that framework for them?
Sure. So again, I go back to no one's going to time when the Fed is going to cut rates. I mean, everybody thought that they were going to do it at the beginning of this year. That's a hard thing to do. And, we respect the fact that, yes, markets have been volatile. But if you look at the S&P with its positive return this year, who would have thought it with rates being so high? So the timing thing is always hard. And we understand that you're getting paid while you wait. But I would say in terms of where areas of opportunity, we've talked about some of those, as I said, where some of these higher quality stocks, be it growth or value, are areas that we still would lean into. Again, I won't rehash what we talked about on the equity side. We're finding opportunities right now that we think are very cheap, despite the fact other parts are expensive. From the fixed income side, high yield right now is an area that we've been making some recommendations with a high degree of conviction. You get a yield to worst right now in high yield of about 9%. Yep. And the underlying quality of the high yield indices has improved measurably because a number of companies during the pandemic, we remember the Fed took rates to zero. A number of those companies refinanced their debt. So we're not facing a maturity wall in any significant degree. Only 10% of the public high yield market is coming due over the next 2 years. And the CCC is just a scant 2% of those maturities that are coming due. Granted, if the economy slows, yes, you're going to have some stresses. You're going to see bankruptcies. We've seen bankruptcies going higher. But when we look at the coupon that you're getting, and what we see is yield to worst typically is a very good barometer for what your next 5-year average return is going to be in that asset class. And if we're going to get 9% now, and let's say if that holds true to form, you get 9% annualized over the next 5 years. That's pretty competitive. Not only is it better than what you're going to get in a money market fund over time, but it actually gives the broad equity market, just at the index level, a run for its money in terms of its rate of return. So yeah, so those are a couple areas that from the fixed income area, especially in tax advantaged accounts. That's an area of opportunity that we think is just ripe right now. And I'm an equity guy, but I can't deny the bond math, Carl. I can't deny it.
Yeah, I mean, especially too if interest rates do come down, you're going to get some appreciation on price. So it's pretty easy to outpace that 5% coupon you'd get on a CD. From an equities perspective, I know we talked a lot about more or less the kind of S&P and large cap space. How are you guys thinking about the small cap space, for example? Just because when we look at performance, they've taken it to the chin this year. Do you guys see that as potentially an opportunity into next year, or you're really still leaning very heavily weighted towards the large cap sector?
Small cap, I say it's more of a strategic, Carl, rebalancing opportunity. So near term, I still think that they're likely to face some pressure. It is a more cyclical asset class, as you know, and many on the call probably are aware of. If I look at small caps, yes, they're PE multiples. If you look at, say, the S&P 600, just as a proxy, a lot of people look at that as a small cap proxy beyond the Russell 2. But if you just look at the S&P 600, yes, you've seen from 2021 to today, the multiple on that index has gone from 16 times to 12. Yep. It's cheapened up considerably. But when you look at if you look at high yield credit default swaps as a measure of risk, or the CDX, that's gone from about 3% to about 600 basis points. And a number of those companies, they don't have earnings, and that's fine. You can't hold that against them. They're early stage. It's just part of what you get in small cap. But they don't have the financial power or the economies of scale that these larger cap companies have. So the way I answer that question is like, look, if you're going to take a more strategic horizon, you're going to look like 18 months or a year plus, then yeah. But understand that we think that there's going to be some bumps in the road, and that's one of the reasons from a near-term perspective we're not highlighting it. But if one is willing to kind of grind through this period of resistance that we expect, then yeah, you've got an attractive entry point to rebalance. But I think more patience is going to be required there.
What about and as we go and finish up here, what about the international space? We didn't spend too much time there. You guys see, that as a potential attractive option? I think one of the charts showed Japan. You hear a lot about them in the news as a great, potential investment. How are you guys thinking about the international markets?
Yeah, we still think that just in where we're at in the cycle, especially Carl, we're favoring U.S. over international. As you know, international struggled against the U.S. Now, a lot of that is the fact that the U.S. dollar has been stronger. So for a U.S.-based investor, that's a headwind to returns. Yeah. But we still think, despite all the issues we have in the United States, we're still on a relative basis in a better position than a lot of the other areas, just from a broad perspective. If we look at areas that still have very strong secular growth opportunity, if it's areas like digital technology, if it's precision agriculture, a number of these things, and a degree, if we do see continued onshoring, reshoring, if that continues, we think the comparative or competitive advantages become even that more emboldened in the U.S. And we've also looked too at, if you look at measures like return on asset that we talked about earlier, if you look at that and you look at our cash flow, return on investment, other measures of quality, to be more specific, there's a skew to the positive in terms of the companies in the U.S. versus those internationally. In other words, those return on assets or cash flow and return on investment are much higher. And given where we're at in the cycle, investors, we think, are going to continue to gravitate to that. And the fact, too, that those indices, if you look at the EFI versus the S&P, it's much more cyclical. So yes, if we get in a broader based global recovery, that could be a tailwind, and other currencies, go the direction away from a stronger U.S. dollar. That could be more favorable. But we think the U.S. still has the edge right here.
Yeah, it's still the best game in town. Are you guys seeing any concerns with some of the conflicts going on in the Middle East now, as far as how that could affect U.S. markets? And then I guess the next follow-up to that would be would there be like an entry of Iran or something to that level where you would really start to forecast any bigger concerns? How are you guys thinking about that conflict?
Yeah, is with any unfortunate geopolitical matter, which clearly this fits the bill in a big way. Sadly, we never really forecast that, Carl, because we just don't have an edge. But we certainly evaluate what could happen. I think that's the essence of your question. So we don't have a high degree exposure in a lot of the portfolios that we talk, even in our value portfolios, to areas like energy, as an example. We do have some, it's about an equal weighting. We participate, pretty well in there, as you would expect in our more growth-oriented portfolios. We'd have none, but the implications, if it were to broaden out, to your point, if Iran were to jump in and U.S. involvement were to escalate beyond what we've been doing more tactically with what's going on in Gaza right now, that would that could raise the risk of a commodity price spike if there was a disruption in the flow of oil, as an example. That would put even a bigger brake on economic growth, not just globally, but in the U.S. And that could serve to rattle markets in a substantial way. Fortunately, we haven't seen that. From some of the data we've seen, is if Iran tried to do that in the Suez Canal, they really couldn't stand up to our Navy in terms of our Navy mitigating that. I hate to be blunt, but they would start blowing boats out of the water if it came to that. But again, we don't know. It's hard to handicap where this goes. The one thing I would say that we've looked at, just for perspective, is we've looked at a lot of different conflicts, geopolitical, macroeconomic, political here in the U.S., natural disasters. And what we've seen is, even in war times, and where we've seen wars, that a year later that the S&P was up about 5%, despite what's going on. So as you and many on the call know, equities are a resilient asset class. It's not to say that we couldn't have some near-term disruption if hopefully it doesn't escalate any worse than what it's already been, which has been bad enough. But yeah, we look at it from the standpoint of it goes back to what I was talking about, net income margins. If you have a company that's more in control of its own destiny, that's not reliant so much in terms of where they source their inputs, if they have a degree of vertical integration as an example, or they're not beholden to some of these other forces, those are things that we try to stress our holdings for to make sure we're not overexposed.
Yeah, and I think that's a good segue as we finish up here. With the opportunity, from your guys' perspective, being in the large cap space, look towards the defensive sectors as being a great opportunity, and the potential opportunity in the value space, just on the comparative valuations against growth. So Walter, thank you so much for going through this high level introduction of where we are macro wise, and taking a deeper dive into some sectors as well. And thank you for joining us today. We appreciate your time.
Likewise, Carl. Thank you so much. Have a great day.
Thank you very much. Have a great day. Appreciate it. Thank you.